Good afternoon, everybody, and welcome to the VITA Off-Season Prep on Tax Law Updates. The time right now is 2 o'clock here for folks on the East Coast, but we'll give it just another minute or two to let people trickle on in. We are really excited to bring this really quick, very sort of interactive conversation to you, and looking forward to talking more in a few. So talk then. All right, good afternoon again, and thanks for joining. Let's get this conversation started. My name is Justin Chu. I am the program manager on the ecosystems change team here at Prosperity Now, and I'm very excited to bring you in into this webinar. For some housekeeping, this webinar will be recorded and will be made available to registrants. All webinar attendees are muted to ensure sound quality. So if you are confused about, the recording of the slides, don't worry. You'll get all of that at the end of the show, at least within 1 week. And feel free to ask your questions anytime and share your thoughts through the text box of the GoToWebinar control panel. This is an interactive conversation, so what we're looking for is if you want to raise your hand during the Q&A session, feel free to do that. Just be sure to raise your hand and enter in your specialized audio PIN. This way, we can unmute you so you can be audible to us during the Q&A session. If not, you can feel free to type in the question box and share your thoughts that way. Let's talk about today's agenda. First, we're going to do a little bit of welcome and intro, and then we're going to talk a little bit about tax. We're going to do one part first, and this is going to be covering some hot topics, which include the CTC, EITC, and EIP. Then we'll do about a 10-minute question and answer session based on that first part. And then we're going to talk a little bit about tax, which is about UI, APTC, forms, and the Child Independent Care Credit. So these are 7 topics that we think are really valuable. We'll do a Q&A on the whole thing, talk a little bit advocacy, and we will do a little next steps and closing. And yes, the slides will be shared to confirm. Apologies if the initial slides were confusing. But for today's speakers, we have Rebecca Thompson, Interim Vice President of Strategic Partnerships and Network Building here at Prosperity Now. Desmond Leong, who is the director of the Metro St. Louis Community Tax Coalition, and then Brad Martin, the VITA program coordinator from the United Way of Southwest Alabama. Well, before we get started, let's turn it over to Rebecca to share a few words from TON.
Thank you, Justin. Good afternoon, everyone, and welcome to today's webinar on tax law updates. It is certainly great to see all of your names here. I know it's been a while since we connected in this way, but we're really excited for this opportunity to share some timely and much needed information with you. Y'all, it's been another whirlwind year. I recall in presentations earlier this year, referring to the evolving tax law as it seemed ever changing, definitely during filing season. So let me again give kudos to you and all of your volunteers for successfully navigating the multitude of tax law changes this year. And looking forward to another filing season of success, and hopefully one that's a little bit calmer and quieter than the last two filing seasons. So today we have a few of your peers who are experts in their own right, most definitely, who are going to share the info and details on a few of the tax law hot topics. And so, as Justin mentioned earlier, these are really the topics that have been at the forefront over the course of the filing season and really are throughout the VITA program, or pervasive throughout the VITA program. And so we'll talk about the child tax credit, the EITC, those stimulus checks, unemployment, the advanced premium tax credit. Oh gosh, the new forms in the child and dependent care credit. Wow. So for many, while tax season does end, of course, we know for VITA that it's actually tax season year round for us. So again, we're delighted to have Desmond and Brad here with us to share their experience and their expertise with regard to these topics. And let me just say to you, thank you again for joining today and for being a part of TON and supporting our network. We look forward to talking with you again soon and connecting with you next month for sure.
All right, thanks, Rebecca. And yeah, so we have the wheel of tax topics up, and this is sort of the framework we'll be using to continue our conversation today. And for the conversation, we'll turn it over to Desmond to share his first section. Desmond?
Hello, everyone. Good morning or good afternoon, as the case may be. I am the co-chair of the Quality Assurance Working Group, and I am to cover child tax credit, earned income tax credit, and economic impact payment. That is the wheel from 12 o'clock to 3 o'clock, I guess. So I'm going to begin with the easiest of the three, economic impact payment, the recovery rebate credit. And I have, well, for 2020, you remember that we had the round one payments of $1,200 for the primary and the secondary, the taxpayer, and $500 for the dependents. The round two payments was $600 for each of the taxpayers that appeared on the return, and the determination was somewhat based on 2018 or 2019 returns. However, the 2020 tax return was the reconciliation of if there was going to be additional payments to be made. As we move into 2021, we're actually looking at the third round of the payments that came out earlier this year in the spring of $1,400 say per person. That was again based on prior year information, but the determination is going to be made on the basis of the 2021 tax return. So we've seen this before. As I see how we're going into 2021, having experienced 2020, it should be a little bit easier to deal with, primarily because we know what we are going up against. 2020 was a little tough because we had no idea what was going on. And now that we've seen how things have progressed with how the service is handling things and the delays in the refunds, et cetera, at least we know that going into 2021, and that might help shape our messaging to our clients. Earned income tax credit. The major change for the 2021 tax season is that it is primarily in the area where there is no children involved. The age requirement, again, I'll just kind of compare prior year and 2021 as the new year as to how the changes impact. But again, primarily it's in that area where there are no children involved. So as far as the age requirement, for 2020 and prior years, the minimum age was 25 years old and the maximum age was 65. So if you had earned income between the ages of 25 and 65 and no children, you were eligible for the earned income credit. The income limits at that time is if you were a single taxpayer, it was $15,820. And as on joint return, it was $21,710. The maximum credit was $543. Now let's compare that to 2021. They have reduced the minimum age, or the minimum age has been reduced from 25 to 19. The maximum age has been changed from 65 to, there is no maximum age requirement. So long as you have earned income, you may be eligible for an income credit. As far as the income limits are concerned, they have been increased. So it increased from the $15,820 from previous years to $21,430. On a joint return, the income limit has changed from $21,710 to $27,830. The maximum credit has increased from $543 to $1,502. So that's really where the major changes are for earned income credit. So we're still talking about if you have a child, 2 children, 3 children, those are still in play. So in a nutshell, that kind of covers the earned income credit changes. Child tax credit, that's where, of course, the major changes are. The child tax credit, the advanced child tax credit. I know that out there on the tax roundtable, there has been much communications in terms of the changes, issues with the portal, the opting in. Those comments are out there on the tax roundtable for the last 2 months or so. But again, by way of comparison, the child tax credit in previous years, it was $2,000, with a portion of it is a refundable portion and a portion is a non-refundable portion. And the maximum age was of the dependent of the child was age 16 as of December 31 of the year of the tax return being prepared. So what I'll do here for the remainder of the few minutes that I have would be to talk about this from the 2021 perspective. So if you've been keeping up on the tax roundtable, and again, I encourage you to subscribe if you haven't. A lot of that information is there. So if you are a subscriber, then this would be more of a review. The maximum credit is $3,000, but there is a $600 additional credit if the child is under age 6. So from newborn to age 6, the credit is $3,600. If the child is the age 6 through 17, that amount, is now $3,000. So they've increased the age, the maximum age from 16 to 17. There's a phase out, meaning that the amount of the child tax credit is going to be reduced based upon what your adjusted gross income is. So that the phase out begins at $75,000 for a single individual or married filing separate, $112,500 for head of household. For married filing joint, the phase out is $50,000. Those phase out amounts seem to be consistent in other areas in terms of your phase outs. Advanced child tax credit. Again, there's been a lot of some promotion about it. There's been a lot of conversation about it, to the extent that there were a number of cities that were where the IRS asked us to open over the summer. And so St. Louis was one of those 12 cities, the original 12 cities that was asked to open to encourage taxpayers to file their returns, particularly if they hadn't had a chance to file the return, and so that they would be eligible for the advanced child tax credit payments. So in theory, I think that was a pretty good idea. But having gone through this and this advanced child tax credit period, it started in June, so late May, early June, and they're still continuing now. Having gone through that summer, I don't know that in our program that we really captured a lot of new clients that were claiming children so that they'd be eligible for the advanced child tax credit. We were just doing regular years, regular tax returns, multiple year tax returns, which is pretty consistent with the way our summer program has operated prior to COVID. However, the website, IRS website, has a number of, well, has one web page that's very good as far as Q&As about advanced child tax credit and child tax credit the payments. So the advanced child tax credit payments were, of course, some based on 2020 tax return filing, and that if you didn't have a filing requirement, you could it was advertised that you could go out to the portal and register. It seems that there's been limited success with that part of the program. And the reason I mentioned that was that during the first week of the Nationwide Tax Forum, the commissioner, he kind of made a comment that there were improvements still being made. I was around at the IRS long enough to understand what those buzzwords meant, is that it wasn't working as well as they wanted it to. So the reality is I think that we're going to see a number of 2021 returns coming in early so that they can claim their children or grandchildren, as the case may be. I would also point you in the direction of that webpage, the IRS webpage, as it relates to it, the Advanced Child Tax Credit Repayment Protection Provisions. So what that repayment protection provision says is that if taxpayer erroneously receives advanced child tax credit payments, they don't have to pay it back. Unless and I think as a practical matter, while this may appear to be unethical, the fact of the matter is it's written in the provisions of the code. So that safe harbor provision is there, and I will leave that to your discretion as to how you are going to teach that to your team. Nevertheless, it is there. But what I have seen this summer in doing some returns is that there were a few taxpayers that came in to file a 2020 return so that they could get advanced child tax credit payments. As it turned out, every one of them rejected for one reason or other. So either it was a PIN or the dependent they were claiming on the tax return had already been claimed. So whatever the gamut was, it ended up to where it was going to be a paper return. So if it's a paper return, and well, you know the situation at the IRS as far as the amount of small paper that they have, that they are working through. Last I heard, they were at about 2 million plus. Maybe they're under 2 million pieces of paper now. Who knows? But in any event, I think the takeaway is that a lot of taxpayers may see that $3,000 or the $3,600 when they filed their 2021 tax return. And we've all been in the VITA world long enough that we know that there are dependents that are being claimed by individuals that where they're not supposed to, but it happens. So one thought that I had was for those for those taxpayers that were truly eligible to claim the child or the grandchild as their dependent to consider applying for an identity protection PIN using the form 15272. Again, I direct you to the website, the IRS website, and to learn about how that can be done, particularly if you are located in an area where there is a taxpayer assistance center in one of the metropolitan areas. There is an option, there's an opportunity for that in-person validation to make an appointment to go to the walk-in area to take care of that. I've been told that once you do that in-person validation, it'll take about 3 or 4 weeks before you get your PIN. So I think with that, Justin, I think that about covers the 3 topics that I have.
Awesome. Thank you so much, Desmond. And this was a great conversation, or a great sort of download of all of the changes that we saw last year and how they're going to try to impact things this year, especially as Rebecca said, through this ever evolving tax season. And now we're going to move a little bit to Q&A, and we're going to share a little bit just about sort of guidelines for participation. I see a bunch of people already put some questions down, but if you want some discussion questions, some things to get your brain juices flowing during the Q&A, feel free to use some of these format-based questions, sort of anything you have going forward for this next filing season, any resources you or your partners or clients need. We'd love to hear a little bit more about that, and yeah, and what works and what doesn't work. We have all been in the VITA game long enough, like Desmond says, to see so many changes, but each change is unique. So what you can do for participation is you can dial in using your telephone, you can raise your hand, you can input in the chat box. Here we go. If you want to be unmuted, feel free to set your audio pin and raise your hand that way. But I have a few questions in the chat box now. And Desmond, I'm going to go first to this question from Bill, which is about the EITC. And And it says, what if the dependent is 19, or what if the taxpayer is 19 and they're still claimed as a dependent? What should one do in regards to the EITC?
Presumably, is the child, I guess, is in college and would still be eligible. I would think that there's no changes in those rules.
That is correct. This is Brad. That is correct. For students, the eligibility has been dropped from 25 to 24.
Okay.
All right, Bill, I hope that answers your question. Next, we'll go to a question from Jim, which is, does the elimination of offsets, for example, child support, apply to the CTC on the 2021 return, or just to the ACTC, which is the additional child tax credit?
I've not read anything that talked about where child support comes into play on this. Yeah, I had gone through a lot of the Q&As and some of the other some research areas like Kiplinger and Wall Street Journal, and I've not seen that. I would suggest that, Justin, if you can send those questions to me, I'd be glad to research them and post a response out to the roundtable.
I will say, this is Brad just throwing in, for the sake of throwing in, I will say Marshall has told me, everyone probably knows Marshall Hunt, Marshall has mentioned to me on at least 2 occasions that the advantage of getting the credit in advance for the PTC versus the CTC versus getting it on the tax return is that as a part of the refund, it is subject to offset, whereas as an advance payment, it is not. I don't have a written source for that, but I would expect Marshall has done his homework on that.
Oh, so you're so actually, okay, now that I understand the context of the question, so it really has to do with if there's some child tax, if there's child support in arrearage, can they capture that?
Correct.
Yeah.
Correct.
Okay. All right. Yeah. I know under previous one, they had talked about that. I'll check back on that. I will check back on it.
Right. Thank you, Brad and Desmond. I have a question here from Stephen, which is, did you notice many taxpayers who owed tax when they applied for the advanced CTC? There were a lot of sort of warnings about that, and I want to hear from Brad and Desmond if you guys saw any taxpayers who owed tax when they applied for advanced CTC. And also feel free to drop in the chat if you experienced this as well in regards to Stephen's problem.
I have no answer to that. I mean, I've not had that experience.
I have. Well, I knew that there was some conversation, even on the 2020 tax return, where they said that there would not be an offset. So a lot of that, I will be curious to see how the software deals with that for 2021. But for 2020, I did see some offsets. Now, whether or not it got adjusted when after the return was accepted and the IRS was working it, because pretty much anything that had a recovery rebate amount on line 30, my guess is that they were pulling them out for what they term it error resolution, but it was really more, I think, to some manually identify whether that amount on line 30 was correct or not. But the way the software was calculating it, if there was, for example, no withholding, the amount of the recovery rebate, whether it be the 12 and or the 6, that was used in calculating the balance or the lesser or small balance. So they were offsetting it. Now, again, what happened when it got to the IRS is anybody's guess.
All right, great. We have time for 2 more questions. I have a question from Anne in regards to the IP PIN. Should one get an IP PIN for the dependents as well?
Well, that's exactly where I was coming from, is in order to give some semblance of control for the custodial parent, that they probably should apply for a PIN on behalf of the dependent. When you're looking at that form 15272, I've helped a couple clients complete the forms out on behalf of their children, and there's a box that the originator of the form would check off to say that this form is on behalf of a dependent. So yeah, this was really targeted more toward the dependent, because keep in mind, if you have some multi-generational some families, grandmother or great grandmother, they are the ones that typically may be owning the home or renting the home. They are the one that would be entitled to claim the dependent, assuming that their income was higher than everybody else's. And oftentimes they may be on Social Security benefits or other type of financial assistance. So that the child tax credit for 2021, it's totally refundable, and and you can get it if you have zero income, which brings up another point about how you're going to file those returns. Well, my suggestion is, and I put it in air quotes, it's my $10 return.
All right, thanks, Desmond. And the final question we have here is from Heidi. And it's, if someone divorces in 2021, but they filed married filing joint in 2020, who will be able to qualify to receive the CTC this year?
Yeah, those are the real life questions that we're going to have to deal with. So what you got is a joint return, and let's say so if there's any advanced child tax credit payments to be made, it's going to be based on that 2020 return. So now we fast forward to the 2021 return, and the divorce has been finalized. Again, look to the decree to see who's going to claim the child, et cetera, et cetera. Well, whoever claims the child gets the advanced child tax, gets that $3,000 or $3,600, as the case may be. So the joint return, so that refund, that advance payment would have been issued to both individuals. And whether that amount is $1,500 or $1,800 per child, you've got that rebate, that repayment protection provision that says that, it essentially says that whoever isn't claiming the child in 2021 doesn't have to pay it back. So the one who gets it, let's say that it's the mother that has custody of the child after the decree and is entitled to claim the dependent, then she would show the additional $1,500 or the additional $1,800, the balance of the other half of that child tax credit payment, that amount would be shown on her 2021 return. On his return, it wouldn't show anything. He's not claiming the dependent, and however they split up that money in 2020, well, that's what essentially that's water under the bridge.
And where that gets dicey, and I'm just jumping in, is when they say, okay, we got divorced in May, I'm claiming the child, but the credit was technically issued to a joint bank account, or that no longer exists, or he got the check or she got the check and I didn't, or whatever the case may be. You're going to have some issues. I know I've seen it with the rebate credits where somebody said, well, it was made to a bank account that I'm no longer on, and the IRS said, well, as far as we can tell, you received it. So it'll be interesting to see where that goes in terms of who says they got the first half of that credit.
Okay, Brad, in response to that, I've had that before, and my response is not my problem. You all work that out. I don't have anything to do with that.
Right.
So in these type of situations, my advice to my VITA colleagues out there is keep it simple. The KISS method.
All right, everyone, there you have it. Let's keep it simple. And in the with that, I know we have a few more questions, but I want to go to Brad to talk a little bit about his section. Then we can circle back to some of these questions we have here in the chat. So Brad, take it away.
Okay. Thanks, Justin, and I will try to move through this as quickly as possible. I'll caution, the internet is actually completely dead right now, so fortunately the phone is still holding on. So if you can't see me on your screen, my name on your participants panel, that's why. So I'm talking about a handful of topics. I don't have a lot to say about unemployment. Last year for 2020 we had the unemployment compensation exclusion, or UCE, of $10,200 in unemployment per individual, provided that income was below $150,000. That, as far as we know, will not be replicated in 2021. Now, what we also know is that things change halfway through the tax season. We learned that this year. We didn't know it before. And so something could change, but at the moment, there's no provision or indication that that's going to happen. Where unemployment comes involved is in the premium tax credit. So let me explain the changes that are involved in the premium tax credit. That's the credit that subsidizes health insurance for those who are on marketplace insurance or state exchanges. And this was something that was kind of off my radar, so I'm going to guess that it was off of a lot of your radars as well. And I'm grateful to some folks who helped me get clarity on this. So normally when you are applying for marketplace health insurance, if you want to have that insurance coverage subsidized with a premium tax credit, your income has to be between 100% and 400% of the federal poverty line or federal poverty guideline for your area for the year in which you enroll in the coverage. For tax years 21 and 22, if your income is above 400% of the federal poverty line, you are still possibly eligible for a subsidy. And the way that works is the applicable figure, which is the number they multiply your income by to determine your percentage of responsibility for your insurance. For people over 400% of federal poverty line is 0.0850, which means 8.5%. So if the second lowest cost silver plan for your coverage is more than 8.5% of your household income, then you would be eligible for a subsidy. However, if you receive more than you're eligible for, There is no cap on that. So let's say, let me make this real because I'm talking in numbers. Let's say that we are a family of 4 and our income is 200%. We project our income is going to be 200% of the federal poverty line when we call the marketplace, and they hook us up with this fabulous insurance plan, and they've subsidized it to a great degree. And then for some reason, our income has really gone up, and now it's 410% of federal poverty line. In past years, you would have had to pay every single penny back, and you might still, if your income, if your income is such that, or rather, if your second lowest cost silver plan is such that you don't get any subsidy. But if your second lowest cost silver plan costs more than 8.5% of your family's income, then you would be eligible to receive some of that subsidy. And so you wouldn't have to pay back every penny like you would have in years past. That's not to say people won't have to pay back, because they will, but the applicable figures have been lowered, so that should result in more generous subsidies, which means larger premium tax credits, which hopefully means not as many people will have to pay back. Now, here is where the unemployment compensation comes in. Anyone who is approved for or who receives unemployment compensation any week in 2021 who is on the marketplace or a state exchange will be treated, assuming they meet all the other applicable taxpayer tests. In other words, they're not eligible for employer coverage, they're not eligible for Medicare, they're not eligible for, some other government program, Medicaid, TRICARE, that would allow them to have coverage. If they are, U.S. citizens, they meet all the eligibility tests, but their income is maybe an issue, or maybe their income is not an issue, but it's higher than this. Those who have received unemployment will be treated as though their income were 133% of the federal poverty line, which means that they'll receive a great subsidy, and if they've already paid for the insurance, they'll get a larger premium tax credit. So that is coming down the pipe. What I don't know is how that's going to look in the software, right? Because we don't see, in TaxSlayer at least, the 8962. So until it's done. So how those questions are going to be phrased, I don't know. I can't answer that. We're way too early out for that. But those are the big changes coming to the premium tax credit. Again, just to recap, you're talking about people who are over 400% of FPL might be eligible for some of that subsidy and not have to pay all of it back, depending on the second lowest cost silver plan on which their policies are based. And then those who've received unemployment compensation, if they're otherwise eligible applicable taxpayers, will receive will be treated as though their income was 133% of the federal poverty line. The big thing that people are kind of not looking at, you take your eye off the ball, something happens, right? And I know we've talked about it a little bit in some circles, but the child tax credit's gotten so much focus that we've because it needs to, because it's affecting things right now. But don't take your eye off the child independent care credit, which is going to be huge this year. And this is why I think it's going to be huge. In past years, I have seen people come in, and I've even had people say, well, I don't have the letter from the daycare. And I look at, this is for people who are have their children in daycare or after school care because they are working or looking for work. And they'll say, I don't have the letter from the daycare. And I look at their numbers and I say, well, between the fact that your standard deduction is as high as it is, and the fact that you don't have, you have non-refundable child tax credit that zeroes out your tax liability, and in the past the child independent care credit has always been non-refundable. So I'm like, it really doesn't help you to go home and get that letter, because it's, at the end of the day, your tax liability is already zero. This year, it's not going to be that way. So this year, for one thing, the child tax credit that Desmond talked about is fully refundable, as Desmond said, which means there's none of that non-refundable credit hanging around that's otherwise going to go unused. But also, the child independent care credit is refundable this year, which means there's going to be huge benefit for that. And this is for 2021 only so far. It's refundable if the taxpayer has lived in the U.S. for more than half the year. The maximum credit rate has gone up to 50%, and that maximum credit doesn't phase out until incomes of $125,000. That's a huge difference. That most people I see, their child tax credit, or I'm sorry, child independent care credit expenses, they max out at usually like, I don't know, what is it, 20 or 30%. It's not a lot. But this time it's going to be 50%. But here's why this really matters. The amount of expenses that you are allowed to claim for work-related child independent care expenses has gone up from, if you remember in past years, it was $3,000 for one child, $6,000 for two or more children, not per child, but total. Now, it's now going to be $8,000 for one child and $16,000 for two or more. Now, I don't know if you would have $16,000 in expenses, but I know daycare is expensive, and even if you're not hitting 16, you're probably hitting more than 3 or 6 if you've had kids in daycare all year. So, this is going to be a game changer for a lot of people, I think. And so the other thing that's happened, and it's happened with the earned income credit too, is there's this weird little provision that it kind of sounds almost redundant in the earned income credit case, but it's a little bit different. So there is a rule that I know it's this year. I don't know if it's permanent or not. I think it might be for earned income credit, but I won't swear to it. If you're married filing separately, and either you lived apart from your spouse and you have a dependent, let's say you have a dependent that you're caring for, and you lived apart from your spouse for the last 6 months of the year, and there's something else. I'm a little fuzzy on what it is as far as if you lived apart at the end of the year. But basically, I thought at first, I said, well, this is just like what we've always done. Because they file as head of household. But this has to do with people. Okay, let's say that Carol and her daughter Maggie live in a house, and Maggie has a 2-year-old, and Maggie makes $10,000. So Carol can't claim her as a dependent. And but Carol can't be head of household or Maggie can't be head of household because she is not providing more than half the cost of keeping up the home, and Carol's not claiming the child, so she doesn't have a qualifying person for head of household. And so basically, it's if you are married filing separately, there are some provisions to allow you to still claim the child independent care credit as well as the earned income credit. Why this matters is for my last topic, which is new forms and changes to the old forms we love. I'm going to go through these. You can see a lot of them because a lot of the draft forms are out. And so I'm getting that from these. All right, so someone asked about students and earned income credit, and this leads to another point. The eligibility, as Desmond said, has been lowered for childless workers to 19. There's a provision for homeless youth and foster kids who have come out of foster care to be able to claim the credit at 18. There will be a checkbox on the 1040 to address that. Some of the big changes you'll see, there's now a line on the 1040 to allow you to report your 2019 earned income. They're still letting you do that. You remember we did that last year for people whose income was higher in 2019 than 2020. They could elect to choose to use their earned income for 2019. And there's a space on the form added for that because they knew it was coming this year. Schedules 1, 2, and 3 are now longer than they have ever been. Remember, we went to half-size pages one year, and then we went back to We combined some schedules and made full sheets. Now each of those schedules is 2 pages. But it's not as bad as it sounds, other than you're going to have to budget for more paper and more ink. I'm sorry to tell you. What they have done is those boxes that were kind of catch-all boxes on those schedules. And I'll give you an example. On Schedule 1, we had the other income. If you go back far enough in VITA land, you remember line 21. So line 21 income could be gambling winnings, it could be jury duty pay, it could be all sorts of things. And what they have done is had separate line entries for each of those items. They've done the same thing with adjustments. They've done the same thing with additional taxes. There's a line for, for example, taxes on uncollected Social Security on wages, uncollected Social Security on Medicare. On retirement or life insurance, all those different things. And the reason that I think they've done this, because they've also done it with all these weird credits that are mostly out of scope for us, but they're on Schedule 3, and it used to be a bunch of check boxes. And I think what they're trying to do is reduce write-ins, and I suspect that is because they want more of this to be processed by computers. And if you write gambling winnings and you misspell winnings, then it doesn't know what to do. And if you, whatever the case may be, I think that this is the goal. So there are lines for almost every kind of other income, credit, additional tax, adjustment to income that didn't have a line before. They all have separate lines now. And so as a result, most of those lines will not be used by us ever, but they will print, and you will see lots of blank lines on your schedules. So that's kind of important to note when you see lines A through L under a certain item. It's really not that you have to answer 12 more questions. There will be, on Schedule 3, there will be new lines because, remember, the child tax credit and the child independent care credit are refundable. And so there will be entries for the refundable portion of the child independent care credit. Schedule 8812, that's the one you see with the additional child tax credit, is now going to be sort of used for anything related to child tax credit, additional child tax credit, or credit for other dependents. If you are a publications person, publication 972 is being retired. It will be replaced by the instructions for Schedule 8812. And so all things child tax credit and credit for other dependents will be a part of Schedule 8812 in instructions. Let's see. Injured spouse forms getting separate lines for refundable and non-refundable credits, and they're removing the line about exemptions since exemptions are at 0. Again, there will be a checkbox on Schedule EIC for married filing separately and eligible to claim EIC. I'm skimming here. 1099 miscellaneous is changing from miscellaneous income to miscellaneous information. I can't tell you why. I don't know. Let's see. A lot of forms that we're used to seeing are going to be, instead of having a year on them, like the dividend statements, the interest statements, 1099As for abandonment of property, 1099C. Those are going to be continuous use forms. They're going to be evergreen, basically. Oh, the big one, too. Do y'all remember the Form 8915E that we used last year? I didn't use it too much, but it was to allow people to delay the payment of taxes on qualified retirement distributions. And it's, in a larger context, it's used for disaster distributions. And in 2020, they came up with the 8915E. That form is being retired. You will now handle those transactions on Form 8915F, along with any disaster declarations, if there are any from 2021, which would probably be out of scope for us. 8915 B, C, and D, which were out of scope, will still exist. 8915A is done with. I don't know why they're retiring E and going to F, but I guess this is the new thing. Change to scope. I know this wasn't on my list, but I'll tell you a change in scope is cancellation of student loan indebtedness. And that is because beginning in 21, it looks like student loan indebtedness can be student loan indebtedness that is discharged it can be tax-free this year through 2025. So we will be able to do that. If you've ever had somebody come in with a cancellation of debt on a student loan and they had maybe gotten on disability, but now they have a $60,000 student loan that was canceled, you've seen how ugly that can be. So that's going to be discharged. It's going to be sort of like principal residence indebtedness. Oh, and that's another thing. Principal residence indebtedness cancellation is a thing, and through 2025 now. We usually go every year going, well, are they or aren't they? It's going to extend through 2025. Private mortgage insurance will be extended for 1 year. So those are just kind of some of the things I'm looking at. And a lot of this you will see, of course, most of this, if not all of it, you will see when publication 4491 comes out and there's that new tax law lesson, and any changes will be seen there. So I think those are the highlights, and I'm happy to take questions and do my best to answer those.
All right, I think that's the perfect bridge to lead us to our Q&A. Thanks for all of that information, Brian. I know that's a lot to take in, and we got a few things already in the chat. Again, I put up some of the guidelines and format questions if you have some ideas or want to get those brain juices going. But in the meantime, I have a few questions already in regards to, this is a question from Diane, which is about how long will the subsidy for unemployment last? I'm not sure in what context, but Brad, or Brad or Desmond?
Well, if you mean for the health insurance marketplace subsidies, that's a good question. The unemployment, the 133% of household income provision, which is to say that if people have received unemployment in 21, they would be treated as though their income were at 133% of federal poverty line. That is for 2021 only. The 2021 and 22 are for people whose income is above 400% of the federal poverty line. Now, as far as receiving unemployment from the federal government, I think that runs out in September if your state hasn't already dumped it. A lot of states have already dumped out of that. And so I'm not sure which question I've answered, but hopefully I've answered whatever question you ask. I hope I answered it.
Great. And Desmond, I know there was a question about IP pins. Desmond, if you want to circle back to that.
Yeah, I can circle back to that one. I realize that as a practical matter, that sometimes individuals are transient, they move around a bit, and they may not get the pin letter. And I think that's what the question it kind of related to. I guess my answer there is that is that's another reality, but at least it does afford some level of protection against someone that shouldn't be claiming that dependent. And that's really what I was trying to focus in on, is that there is a way to do it. Now, granted that personal situations may cause a barrier, but I think as a practical matter, there's a lot of life changes that we can't fully embrace all the time. Is that here's an option. It's certainly better than having someone claim a child that they're not entitled to. And that was primarily my focus, is just to come up with another way where the custodial parent has a little bit more control over that kid's the Social Security number.
All right, got a question here from Norman, and it's the federal deduction of unemployment insurance amount of $10,200 only existed for 2020.
Yep.
So does that mean for 2021 there is no such deduction?
At this time, yes.
Mm-hmm.
That's correct.
Mm-hmm.
Okay, and got another question here from Steven. And the question is, was married filing separate ever allowed for EIC in prior years? And is it now? Now it is. So sort of a question of the history of that.
Okay.
It was not allowed. Go ahead, Desmond.
Yeah. Okay. The reason it's not allowed is because because pretty much any credit that is tied to a family's adjusted gross income, whether it be American Opportunity Credit, Earned Income Credit, anything that's tied to adjusted gross income, the married filing separate essentially kills it. You're not eligible for it. So that's the way. I mean, that's the history of those credits.
And the possible exception to that would be the child tax credit, because I know a lot of people in upper incomes who will file separately for that reason. But this year, there's, again, provisions for separated spouses who do not live together and have children that they're able to claim. So to answer your question, Stephen, that's why it's a little bit different. And most of those folks are probably filing head of household at this point. It's just for the ones who are not able to do so that you might have a very narrow carve-out exception for them this time.
All right, got another question here. Thanks both of you for answering. And it's, will the taxpayers have a document from the IRS showing the amount of ACTC that they received? I was curious if any of you guys have a head. Yeah.
Yes, they should have. They should receive. Now, again, remember, we were supposed to see lots of those for the stimulus payments, and half the time people didn't know what they got there either. But there should be a document of some sort. Desmond, do you know the number on that? Does it have one yet? I'm sure it does.
On the tax credit, no, I do not have a number yet.
I was gonna say you're my numbers guy, but I don't think I've seen one yet.
I haven't seen one yet.
But I'm sure there will be one. Yes, there will be a document that shows how much they received. And there again, that's where it could get a little bit interesting, depending on, especially with divorced and separated couples who split up this year. But yes, the letter should tell you that. And in theory, we should also see those for the economic impact payment number 3. A lot of us didn't get some of those, and sometimes I got one late, and we got those back in April, May. So whether people save those, I don't know, but hopefully they'll keep up with the ones for the additional child tax credit a little bit.
Yeah, I got something from Jim here in the chat, which is ACTC will be reported in the letter 6419 in late January 2022. Thank you so much, and thank you, Christine, for also putting that in the chat. And Vicky, now we have a question from Diane, which is, as of now, it looks like that they will continue to allow retirements distributions to over 3 years in 2021. So do you guys have any thoughts on that?
Okay, if you started that process in 2020 and you did the 3-year ratable reporting thing, then you'll have to report a third of that in 21 and a third of it in 22. Desmond, are they doing that again in 21? I have not heard that.
I haven't heard that one. Yeah, that one. I will go back through my Kiplinger stuff and see if that's in there. I kind of ran through that as I was prepping for today's the presentation, but that's an interesting point.
Yeah, I've not heard that. I've only heard. I mean, obviously, if you know, and I had a few people that I worked with to do the 3-year ratable reporting thing, and I put lots of notes in TaxSlayer that said, in 2021, this person will need to do, you know, to carry forward that information from the 20, and there again, that's where the 8915E information went last year. It would go on 8915F this year. I've not seen the draft of that form yet. My internet has come back up, so I will look and see if there is one. I don't know that there's one out there yet.
And while you're doing that, I'll check with Kim to see if that information is going to be part of the carry forward. For the 20.
That's a good point. I put it in notes because I wasn't trusting that it would be.
I understand, but the thing is that those are the items that cross my mind. So I will ask. There was a question that came up earlier in the last portion of Q&A about offsets of the advance of the child tax credit payments. I posted, I think, excuse me, it's in tab G of on the IRS Advanced Child Tax Credit, the webpage. Tab G has several questions that talks about child support offsets as well as garnishments. So take a look at that and hope that that would answer your questions.
All right, thanks, Desmond. I have a question here from Teresa in regards to, do we think we may have to delay appointments for families who have not received the letter showing the total ACTC that they received? So what do you guys think about a delay for people waiting for their letters?
That's a tough call, because if you delay families, they're already going to be delayed enough because they're going to have to wait for those returns to be processed with the IC and any refundable credits as it is. You want to get those in, but if they don't have that letter, are they going to get delayed for months if the numbers aren't right?
Well, and then now we are assuming that the payments that are being received by the individual is the rightful person. And with that being said, I think a lot will go into the interview. For some reason, I just see this coming season as well. Let me rephrase it. I would be very interested to see what the new intake sheets look like and whether or not there will be a need for us to come up with a supplemental intake sheet to ask those questions that are not being asked on the IRS intake sheet. I just got a sneaky feeling that that may rear its head. So, but in answer to the question, Teresa, my suggestion, again, getting back to that interview, hey, did you get the 250? Did you get the 300? I mean, they know if they got it. Now, the question is that, and then try to do the best guess and still complete out the return. Because regardless, you know, my thought is this, having gone through the recovery rebate situation, anything that's going to be in there about child tax credit, they're pulling that one. They're going to check. And so that's why I really anticipate another delay on those refunds coming out again.
Great. Thanks, Desmond. There's a question here from Chris, and they say, there's always been an exception for taxpayers who lived apart from their spouse for the last half of the year and met certain requirements. These taxpayers could be, quote, considered unmarried and use the HOH head of household status. The new checkbox in the draft schedule EIC seems to refer to this. Are you saying that taxpayers who actually use the married filing separate status can claim EIC in 2021?
Well, that's always been that's always kind of been on the books where if because I know of several situations where husband and wife split up before July the 1st, and mom took the kids, and someone moved out, went to another place. They filed head of household in that year, claiming the kids and their income credit. So
Right.
Now it's maybe they're just recognizing that on the EIC form, but that's always been part of the head of household rules and earned income credit.
Right. And that's what Chris is saying, is that's always been a thing. So what is different now? And what it seems to be different from what I've been able to read is that, okay, let's take your exact same scenario. So mom moves out, takes the kids, moves in with her mother, and her mother can't claim her as a dependent. She's claiming the kids, but she's not able to be head of household because her mom's providing more than half the house, keeping up the home. So she has to be married filing separately. And so there's this provision that says they lived apart for the last 6 months of the year. And so in this case, that's my understanding from several things and conversations that I've had. And I will find something a little more substantive to back that up. But I've got some notes here from some meetings that I was in, and that's where that, because I had the exact same reaction, by the way. When I read that, I'm like, so what's different?
Right.
And and I think it's as I said earlier, I think it's a very narrow carve out for those folks. I don't think you're going to see this a whole lot, so I wouldn't stress too much about it. I think most people, as I said, are going to do exactly what Chris said and what Desmond said and file head of household, and that won't be any different than before.
Thanks, y'all. Chris, hope that answers your question. I have two points here from Jim and Teresa talking about, they want to hear a little more about your thoughts on using 2019 earned income on the 2021 return. So this is about EIC look back. Does this apply only to EIC, or does that also apply for CTC? So this is about income look back.
That is a good question. Let me see if I have something in my notes about that.
Hey, Brad. When I was researching Kiplinger, there was a sentence I saw that's even on the 2021 return, you could do a look back on 2019 for purposes of earned income credit. I don't know about child tax credit, but yeah,
that's what I was checking. I knew that it was applicable for earned income credit. The notes that I have do not mention the child tax credit in that context. So I don't see anything that says no, but I don't see any. It specifically says here earned income credit. So my notes match your notes.
And before you hit the next question, okay, Justin, is that I wanted to make a comment about that student loan, it's indebtedness situation. I've had a number of those over the years, and the pretty much what this provision that Brad covered was really more along the lines of making it easier to deal with, because in many cases, or actually in probably all cases involving our client base, is that when you it gets back to the issue of insolvency before
Insolvency, exactly.
of the debt. And so the thing was is that we had to attach a separate document showing the insolvency along with the 982. In this case, now we can just say it makes it easier for the VITA community to work those cases.
Which is why they made it in scope this year.
Yeah, right.
I would agree with that.
Mm-hmm.
Okay. In terms of talking about look back, we have a comment here in the chat. Thanks, Jim. Talking about probably for EIC only, given CTC no longer has an income requirement. So thanks about that, Jim. In regards to the look back, Tamara asks, do you use 2019 earned income for look back, or do you use 2020 earned income for 2021?
2019. I wondered the same thing, but it's definitely 2019, and that's because they're thinking that for a lot of people, 2020 would not be helpful because it would not be higher than 2021. If anything, it would be lower. And so I'm not saying it's always the case, but that was probably the thinking. And Jim's comment makes sense as well, since there is no income requirement for CTC. That makes perfect sense, and that's why it does not matter. So thank you for that. That's logical.
Got another question here from Graham. Thanks, Graham, for asking, which is, how long does it typically take for the IRS to investigate when someone's dependent is claimed by someone else? These situations happen quite often. Yeah. And he wants to know, just based so he can tell what to tell clients and how long they can expect that process to take from their perspective. So you're saying a long time?
Well, I mean, I know that's not a good answer, but it's always taken, in my experience, months to do it, and that was before the IRS got backlogged. Remember, in most cases, if the child has been claimed erroneously, you're filing a paper return, and we all know the paper black hole that we've seen this year. Normally, it takes months and months for them to go through and ask questions and whatever they do. Desmond, you speak this more than I can, I'm sure. But am I off?
Well, I've seen where it usually takes between 9 and 12 months. And the reason I say that is because of the IRS rules that relate to aging of tax returns. So when you look at it in the context of when CP 2000 letters go out, in this case, CP 2000 some letters have gone out on 2019 returns for a while. Those dual dependency letters, I've seen them in years past. So I would say in pre-COVID, it usually took about 9 months. I always tell the clients, I said, it's just like pregnancy. That's when the baby comes out. So that's when the letter comes out.
All right, thanks everyone for that, and thanks for asking all of your questions.
Justin,
Go ahead.
May I throw one more thing? I'm looking at notes that I have. There are on both the 2441 for child and dependent care credits and on the Schedule EIC, there will be check boxes to mark if someone is married filing separately and filing as not married for purposes of claiming those respective credits. So it isn't just the head of household thing we always know. I knew I'd seen it, I just had to find it. So yes, there will be new check boxes on both of those forms. So that is what we're looking at. Again, it's that narrow carve out I talked about.
Awesome. Thank you so much, Brad. Thanks for that quick clarification. And I think I have one or two more. This one's from Goldie in regards to the advanced CTC. And this is about filing status change from married filing joint to married filing, or actually to single or married filing separately. Not quite sure because it just says S. But either. So what do you have?
What's the question?
What are there what kind of changes are there to expect if your filing status changes from married filing joint to either married filing separately or divorced, single?
Single. Well, I think that's kind of what Desmond talked about, that you'll run into, that's going to be a matter of circumstances and facts of the situation. Who is claiming the child? Who received the payments? When those payments got mailed to whatever address they got mailed to or whatever bank account they got deposited into, who received them? Who does the IRS think received them? If the IRS doesn't know you're divorced and they send the letter and it's in both your names, again, we don't quite know what that's going to look like yet. But I think it's going to vary from situation to situation, depending on who's claiming the kids. And if you thought there was a race to hurry up and file and claim that kid before the other parent did before, it's really going to be hot and heavy now.
Mm-hmm.
Great. I don't see any more questions here in the chat. So I will let you guys say any sort of final thoughts you have after we've talked almost for 80 minutes straight about, a lot of topics, a lot of really dense topics. We have a few links in the chat, so feel free to pull those up and save them for your, advanced CTC questions, as well as draft tax forms. But I want to hear a little bit either from Desmond or Brad first about what you expect to see going forward and any sort of final words.
What I expect to see going forward is a mad rush to file tax returns to claim these kids to get that child tax credit. I really see that to be a big situation, and be prepared for rejects, well, that is to be prepared for rejects. You may see a lot.
And I would add to that, and in complete agreement with Desmond, what I think you're going to see, if you've been doing this long enough, you typically have thought of the first few weeks of VITA season as fairly easy, in the sense that most people who come in just have W-2, they're trying to hurry up and get their big refunds, whatever it is. And so those tend to be easier returns. When I worked with the National Civilian Community Corps group, I was grateful they came at the beginning of the season, because the returns were a little bit easier for them since they were 20 and had never done taxes before. Whereas by March, you're getting the brokerage statements and the retirements and all that kind of stuff, right? This year, I think you're going to have to be on your game in January, because I think you're going to Desmond's point earlier, you're going to have to do some serious interviewing and figure out what's going on and what the circumstances are, and that you have all the information. I think you're going to have to be a little bit sharp in the beginning, and that's going to mean training-wise, we're going to have to I think we're going to have to focus a little more than maybe we all have in the past, or some of us have, on interviewing and being able to have the courageous conversation.
Thanks so much, you two, for sharing your thoughts. To answer some of your other questions, we will, I know that we typically don't do transcripts, but I know this has been a really, really valuable topic, so I will put on my best stenographer hat and get that transcript out to you. It might take a little bit longer, but I know this is really important, so I will be sure to transcribe this as best I can. But in the meantime, I have a few more fun things for us going forward. As always, we have a few plugs here at Prosperity Now that we always like to cover. First of which is our advocacy opportunities. So if you are interested, you should always check out our Prosperity Now Advocacy Center. We do a lot of tax and ton focused stuff on that advocacy center. So I would highly encourage you to join. That's prosperitynow.org/take-action. These are great campaigns, usually one to two clicks, directs you to an email, call, tweet, even a scheduled meeting. I mean, these days it's a little harder, petitions, all that kind of good stuff. So we highly encourage you to join. In the meantime, we have a little bit on the next steps and closing. I have special for you, for all 110 of us here on this call, a little virtual VITACon sneak preview. So here I am going to put in a link for the virtual VITACon agenda, sort of what you want to see, basically. This is something that we have been working really hard at here at TON to get going, and we will say that that it's coming up. So keep your end of September clear. We will have a little more information and more of a formal invite coming out on all of our channels soon enough. So keep that in mind. But if you want to put in a special word either for your agenda ideas, right? We talked a lot about a myriad of different tax topics, and that's great, but there's a lot we have on offer. Feel free to click that link in the chat just now. It asks you to tell us a little about who you are, what you want to see at Virtual VITACon, as well as share a fun photo of yourself. We want to do sort of a little, add some photos into our presentations, spice them up, of where folks are calling in from, your VITA site, even your VITA setup, what you did throughout the year. These are ways to help us connect, and we're super excited to have that going on. So feel free to click that link. In addition, there's also going to be another survey, but this one's just associated with the webinar itself, about sort of the metrics and how you enjoyed it. So please do take the time to answer that. And we'll put out all the links that we did in the chat before. So that's advanced CTC stuff, tax roundtable, draft forms, all that kind of good stuff. And you can expect to see the PDF of the slides, as well as a transcript and the recording within a week to 2 weeks, depending on how fast I can type. But thanks again so much for joining. This has been a really insightful insightful conversation, and we hope to see you on the next call. Till then, I've been Justin Chu. Thank you, Desmond and Brad, and look forward to talking with you on the next webinar. Goodbye.
Thanks, everybody. And Justin, if you would give me a call for just a second, I'd appreciate it.
Yep, no problem. Talk soon. Bye, y'all.
Thank you. Okay.